Thank you, and good afternoon, ladies and gentlemen. It's such a pleasure to be here in Nairobi at the start of the year, almost, to explain to you how we see things with the global economy. It's useful to have a prop to be able to change the slides as we go along. Let's get right in. In this presentation, we're going to be laying out the global outlook, why we're particularly optimistic about 2018, how this does mean, after several years of fairly difficult external conditions, an improvement in the overall trend in Africa, and more specifically, what it means for Kenya. Now, some of you will know that we've received a lot of attention for our growth forecasts. We were a little bit more bearish than the consensus in 2017. We see a growth improvement in 2018. It is difficult to be here and not to pick up on the optimism that is all around us. But we're also very measured in assessing the outlook in the future. What does everyone in this room really want to know? My guess is it's not what happened last year. Each one of you already knows that. Last year is over. What we hope to focus on are the longer-term reforms that we need to see in place to bring about sustained rates of high growth in the Kenyan economy. What matters now isn't so much what can be done to immediately change prospects this year. It's a little bit late from the perspective of the lag between changes taking place, policy changes, and that eventually impacting the economy. There are certain key asks, but what is most important this year is how it establishes the basis for sound reform in the future. What kind of growth possibilities it opens up for the Kenyan economy over the medium term. With this in mind, let's look at the good news about the global economy. Most of you should be feeling relatively upbeat and with good reason. The global economy is turning around. At the end of 2016, beginning of 2017, some uncertainty. Markets were rallying on the back of that Trump election. Was this irrational exuberance? Would it turn out to be far risky than the markets were actually discounting? There was a lot of concern around what would happen in Europe. Political risk. We tend to think of political risk as something we associate with emerging markets. But we had seen the rise of all these Eurosceptic parties, and there were key elections happening over the course of 2017. A key question for Europe was the whole thing going to be able to hold together in the wake of Brexit? Would we see more Eurosceptic parties rising more strongly? And what of China's growth? China, which had seen these years of incredibly strong investment, many would say over-investment, not really paying that much attention to what was being invested in, was now trying to rein back. Looking at a much higher leverage ratio, looking at the buildup of debt, Chinese policymakers were trying to bring about a rebalancing of growth, not allowing the economy to be as dependent on these super turbocharged rates of investment as it had traditionally been, but to bring about a gradual rebalancing that would allow for domestic consumption to become more important. So when we take a step back and we look at the global economy, actually we're in a good place today. Lamin made mention of the kind of growth forecasts that we see in place in 2018. The good news is that the US economic expansion is still going strong. We haven't seen the Fed having to tighten very aggressively. We haven't seen that shock. Inflation looks relatively well behaved and benign, despite the tightness of the US labor market. China's growth surprised positively in 2017. We saw the first year-on-year acceleration in China that we had seen since the global financial crisis. That's important, and it's happening in the context of the rebalancing, with consumption becoming more important. China's policymakers have pledged to their people that by 2020, the economy should be double the size that it was in 2010. We think this is a commitment to continued growth. We don't need to worry that China's commodity demand is going to dissipate. As China becomes wealthier, and we've seen this from the experience of other countries that become more wealthy, with incomes growing, demand for commodities will naturally pick up. It doesn't need an unsustainable rate of investment growth to drive that. And in Europe, with reflection, a lot of positive surprises. Those big risk events, the other elections, somewhat better outcomes than the risk associated with the Brexit referendum. It wasn't necessarily the Eurosceptics that came to the fore. Business sentiment indicators started picking up. In turn, the survey data turned into more positive economic data. So if we're looking at 2018, commodity prices are supported, global growth is back, everyone seems to be fairly measured about the risks. This is a good place to be. Let's examine this a little bit more closely. What could go wrong? Where are the risks? A few years ago, when I was last here, we were talking about the US economic expansion having run for a significant amount of time. That expansion has been underway since mid-2009. By the time scale of typical US economic upswings, it's getting old. And the question is, are we going to see growth weakening? Or are we going to see a continuation of this very good set of conditions we've had? Growth, but no real threat of inflation. If we're looking at the risks that the global economy faces, there are three key ones that stand out. We've gotten very used to an unusual amount of monetary accommodation in the wake of the global crisis. We saw this with quantitative easing being adopted, major central banks pumping money into their economies, the balance sheets of different central banks growing very strongly. And we're all very comfortable as investors with the idea that there aren't many shocks on the horizon. Inflation really isn't a threat. The labor market has tightened considerably in the US, but we just haven't seen the re-emergence of inflation. So here's a risk. What if we're wrong? As economists, we're always asking, what if we're wrong? What if there should be some kind of shock that forces the Fed to start tightening at a rate that markets just haven't priced in? That is a risk. The reason why is that the global economy has become very used to cheap, easily available money. We saw this with the amount of external debt issuance across a range of different African countries. And so, if anything should happen that alters our thinking on the inflation risks and the Fed are forced to tighten that much sooner, that could disrupt quite a great deal. It's untested. Everyone has gotten very comfortable with this idea that the pace of monetary policy accommodation can be removed very gradually, that the fact that we've all gotten so used to that much more borrowing and that the world economy is that much more leveraged, and we've seen the growth of credit and the growth of borrowing in so many of the world's emerging markets, that we can take this in our stride. There's a risk, of course, if that goes wrong. And then there's global trade. For many years after the global financial crisis, the concern was that that traditional relationship, the growth rate of trade relative to the growth rate of the global economy, where trade usually grows at a multiple of economic growth, that had broken down. Last year, we saw with a lot of factors very closely associated with China's inventory cycle, a strong push behind global trade. Even though we had seen the election of Trump in the US and everyone was, super aware of some of the risks posed to the global trading framework, we actually saw trade numbers recovering nicely. Across Asia, many emerging markets saw this positive boost, demand for their exports coming from China. And so a third risk will be, well, what if that was just temporary? That was just a feature of where we were with China's restocking that was going on at that point in time. It's good to be aware of the risks, but let's look at these factors more closely. The first one, and it's always good to have these very involved charts, I want you to focus on the blue line, which is the trend of global GDP growth. You will see the dip in global GDP during the crisis, and you'll see that looking at the average that we've seen in the post-crisis years, that's the dotted blue line, we're now above that average. But we're still not back to the kind of average GDP growth that we were seeing pre-crisis, the red dotted line. What is this telling us? Yes, we're feeling good about growth. Prospects are looking better. Things have improved. But they haven't improved to the extent that we've overcome the impact of the global crisis. Global growth is not yet back to where it was during those very heady pre-crisis days. There's another feature that has changed, and many of our presentations year after year since the crisis have focused on this, and that is that there has been this perceptible shift in the balance of economic power. After the crisis, it was especially profound. The emerging countries, economies like China, started to contribute much more significantly to global GDP growth. Other Asian economies were benefiting from that, and their contribution to global GDP also started to increase significantly. If you look at the countries colored in red, this means that even though they're still quite sizable economies, the United States and the Euro area are quite dominant there. Understandably, these are large economies, but their share of global GDP has been declining. And what about Africa? In Africa, we congratulated ourselves that we didn't have a particularly profound, long-lasting crisis. Yes, there was a dip, but with the impact of QE on commodity prices, demand came back, growth came back. Well, the fact is that for all of Africa's potential and the demographic potential of this region, that share of global GDP hasn't been increasing as robustly as has been the case with Asian developing economies. This doesn't mean Africa hasn't been growing. For the most part, it had been. But what this chart seems to be suggesting to us in a very graphical way is that there is more work to be done. Let's talk about some of those risks. Now, to give you a sense of the amount of easy money that we've all gotten used to, it used to be unthinkable at one point that we would see the large dollar issuances, the borrowing in international capital markets by African sovereigns to be funding their infrastructure. You know, external borrowing was seen as prohibitively expensive, but not so much in the wake of the global financial crisis, largely because of the impact of global central banks. We saw an incredibly strong amount of quantitative easing. Essentially, central banks printing money, growing their balance sheets, pumping this money into their own economies, usually through the purchase of financial assets. And that has had an impact on the performance of financial markets. So what we plot against that is the year-on-year rise in the S&P 500 index. And you can see a very close correlation. Throw more money at the issue and asset prices start rising strongly. It's nice for those who happen to own those assets. It may also have helped to contribute to greater income inequality in some instances, but this is where we are. Why do we raise this as a risk? Because we now know that the process of tapering all of that has already begun. In the US, that process started earlier than many of the other developed economies. But looking at the ECB cutting down its asset purchases, we expect QE to come to an end. The Bank of Japan is moving in the same direction. This incredible stimulus that the world economy has benefited from is going to come to an end. Things are going to change. And as much as we've become complacent with the kind of growth that was possible, with the very benign external environment, we do need to think seriously about the implications of this for just about all countries, especially those that have borrowed externally. At Standard Chartered, we produced an index of external vulnerability, just looking at the various factors that would feed into how susceptible to a crisis different countries were. And a very easy pictorial representation where you see a country coloured in red. So Venezuela, I think it is, that tops the list. No surprises there. That suggests a great vulnerability to an external crisis. Yellow, yes, it's a tentative situation. Maybe improvements can be made. Things can be done to strengthen resilience. And green is seen to be a lesser risk of an external crisis. Now, the good news for those of you looking at what colour Kenya is coloured in is that, yes, an external crisis is not seen as one of the key risks facing this economy, not necessarily. And this is a good place to be. But what we also need to think about is what are the additional measures needed to strengthen the resilience of growth that is possible in Kenya. In particular, the volatility of growth from year to year. When I'm asked what is it that, to your mind, distinguishes the performance of many African countries from their Asian counterparts, and we know that sometimes the economic models are different. There's much more of an export-driven growth experience in Asia, a reliance perhaps on somewhat undervalued exchange rates. Manufacturing was a big part of that. Is that going to be easily replicated in Africa? Is it too late? These are big questions. But there's one point to be said for the consistency of growth. Many sub-Saharan African countries, especially those that are commodity dependent, or maybe even those that are especially weather dependent, have been particularly negatively impacted because of this volatility in growth. We've done a lot of work at Standard Chartered in recent years about the emergence of a middle class in Africa. And one of the things you do need is this consistent source of income. The middle class in Africa has been disadvantaged because in good years, you might see more people escaping poverty levels, but there's a great vulnerability to that story. As soon as a particularly severe shock hits, a lot of those people tend to be knocked back under the poverty line. And you don't get the development, the broad-based development of that lower middle income class, let alone the higher middle income, as much as you would like. So the consistency of growth and strengthening the buffers, reducing that vulnerability to external shocks is important. Another risk, and this has had a lot of attention in Kenya as well. We know that many of those rapidly growing frontier economies, a lot of those Asian economies too, that we saw increasing their share of global GDP, well, that story hasn't been without its underpinnings in the accumulation of debt. A lot of the world's emerging and frontier economies are much more leveraged than they were even a few years ago. And when it comes to the repayment of a lot of the debt that's been taken on, that's not considered to be a great problem. But for an increasing number of economies, if you look at the amount that they're spending on debt service relative to what they're collecting in revenue, you can see quite easily from this chart that it starts to be more problematic. In Kenya, looking at the amount of revenue spent on debt service, Moody's suggesting that's now about 19%, up quite significantly as a percentage from where we were just 5 or 6 years ago. Looking at how debt maturities are going to be factored in, is the amount of revenue being collected sufficient? These are going to be important questions to answer. We're looking at this in the context of those global risks. We feel good about the global economy. Things look good. Where are the risks? The countries that have been growing rapidly have also been accumulating debt. While we're not overly concerned about the resilience of many economies out there, we do need to pay attention to the financial risks. If we see a greater tightening of global financial conditions than markets have factored in, who's going to be resilient? Who is going to be prepared for this? And in the context of Africa, we will also look at the ease of refinancing the debt that has been accumulated. How do different countries stack up? A quick chart on the US economy. We've been saying this for a long time. If you think there's a lot of, variation in the Kenyan economy forecasts, well, even in the US, possibly the most analyzed economy in the world, there hasn't been a good record in terms of where the consensus for growth starts out and where it ends up at the end of the year. Almost since the end of the global financial crisis, there's been a tendency to be overly optimistic about US growth prospects. And gradually, over the course of the year, there has been this downward revision to the growth forecasts. This year, the consensus is fairly healthy, 2.6%. We think, just because the economic cycle has been running for so long, there are question marks about how much tightening it can withstand. We think that there's a chance that those growth forecasts may still be revised down further. The consensus may have to shift. But for the moment, there is a sense of optimism out there, and that is important. Some of you are sitting up here in the audience, it's after lunch, and you're thinking, get on with it. How much do I really want to hear about the US economy? But this is important to all of us, because what happens in terms of the thinking on global growth, where global risk appetite is, are investors still feeling good about everything? Are they looking for those high-yielding opportunities? Are they putting new money into economies like Kenya? This is going to be governed in part by their perceptions of what might be happening in their home economies. So, a final global risk before we look more closely at the Africa picture. Oil prices, not too hot, not too cold. Where do we see things? Very easy answer. Standard Chartered's forecast, average price forecast, Brent crude, 2018, $61 a barrel. I can rely on the work of our excellent Commodities research team, so all I'm doing is really relaying to you the benefits of their analysis, and they've been more right than most other houses out there. What was happening last year? The global economy was growing. Global growth, global demand was picking up. The markets for the longest time were ignoring this. But after that OPEC meeting in November, the extension of OPEC production cuts, and this is really OPEC being on top of their game. For the moment, the compliance with the OPEC production cuts is good, and this has helped to create some support to the oil price. We know that global demand for oil has been rising, and for much of last year, markets just shrugged it off. But now, in recent weeks, and we opened the year with so much exuberance in the oil price, what the market is factoring in is the fact that through these years of weaker oil prices, there just hadn't been sufficient demand, there just hadn't been sufficient investment in new production, especially from non-OPEC sources. So it's this tightness in the market. If the global economy continues to grow as we expect it will, demand is going to be rising. And you know what? The investment in new production that should have happened some years ago didn't happen. So that's going to be supporting prices. And for an economy that is overwhelmingly oil importing, like Kenya, this is a very relevant risk. Now, why do we think the rise in prices that we saw early in the year was overdone? $70 a barrel, looking really exuberant. And this is because of the shale production numbers. One thing we are expecting this year is that those shale production numbers are going to be off the scales. They look very dramatic. Shale production is coming back in a strong way. And so when the market starts factoring this in, and as we see more and more of those releases coming through, it will temper some of the optimism that's priced into markets already. What's our best take on oil prices? Well, $61 a barrel. We really don't see longer-term conditions being in place that will drive far greater oil price strength. The good news for Kenya is that we're probably not going back to triple-digit oil prices anytime soon. Remember when Kenya had that hugely strong current account deficit, partly reflecting the fact that there was so much more investment going on in this economy than could be sustained by domestic savings alone? That essentially is what a current account deficit is, a savings investment imbalance, but also being driven very substantially by the fact of high oil prices. We're not seeing that level of external pressure in Kenya, but we are going to be seeing higher oil prices. As much as there is optimism in the economy, elections are behind Kenya. The focus can move to what to do in terms of building the future. We can't ignore the near-term impact that higher oil prices will have on this economy, and that is something that serves as a drag on growth. So with that global introduction in mind, let's look more closely at what it all means for sub-Saharan Africa. African growth in recent years had disappointed. In 2016, we saw the weakest growth performance in Africa since the global financial crisis. There wasn't much to the Africa rising narrative. Because of the collapse of commodity prices in late 2014, many people had started to question the underpinnings of the Africa rising narrative. We think that was a little bit overdone because Africa is not one country. The growth experience isn't necessarily uniform. In fact, when it comes to GDP-weighted growth in Africa, there are two economies that have a disproportionate impact on overall GDP growth. And it just so happened that in recent years, especially last year and in 2016, growth in those two economies was especially weak. Nigeria and South Africa, between them, account for over 50% of sub-Saharan African growth. So if we're looking at a regional average and those two big economies are underperforming, it really doesn't matter if you have one of those small economies that people hadn't paid that much attention to. Senegal, the best growth in 13 years. It's not going to compensate for the giants not performing as well as they should. Nigeria saw an outright contraction last year. It started to put in place positive foreign exchange reforms, but it was still paying the price for the sluggish adjustment to weaker oil prices. And that dragged down growth. The economy still contracted overall, we believe. South Africa, we've seen more encouraging signs now. With the recent political change in the ruling party in South Africa, we expect that both business and consumer confidence will get a shot in the arm. We're already starting to see better retail sales figures. It looks as though there has been this element of pent-up demand. It's starting to come back. People are feeling more positive about the future. South Africa still has a great deal of challenges to overcome, but we think we've reached a turning point. Higher oil prices for Nigeria, hopefully more stable output. It is going to be the lead into an election year for Nigeria, but a big turn just in terms of sentiment in South Africa, which should gradually translate into better economic growth. So it's a fairly safe call. Africa's growth, it's going to be looking different. Another reason is, of course, the continued China-Africa engagement. What we saw strongly in 2017, associated with China's restocking the inventory cycle, was a strong boost to Asian export growth. In some instances, there is a concern that this is a little bit temporary. But we usually see higher commodity prices feeding into activity in much of sub-Saharan Africa with a lag. We know that Chinese-African engagement has grown very strongly over the decades. We saw this big improvement from 1995 to 2005 when trade grew almost tenfold. A big improvement through to 2014, and then commodity prices collapsed, and the value of that trade was impacted by that. But we do see this coming back. We think as China becomes wealthier, the demand for commodities is still going to be there just because of China's rebalancing. Don't ignore this very positive effect that is going on. But here's the adjustment that African countries, African economies are still coping with. On this chart, we have different commodity prices rebased to a single starting point, the beginning of 2014. And you can see the differing performance from the different commodities. We're probably not going back to triple-digit oil prices anytime soon, barring a big oil shock, supply shock somewhere. Copper prices rallied strongly on the Trump election victory, the thinking that infrastructure spending in Africa. With the decline in commodity prices that we had seen earlier on, African economies are still in some ways adjusting to this. It's good news that we've seen stabilization. This will lead to a turn in investor sentiment. We'll see it with portfolio inflows first. Eventually, this should translate into broader-based foreign direct investment. But at the back of our minds, we should not be forgetting that the slightly weaker growth trend is because the adjustment to this big shock that had been seen in 2014 is still ongoing. In terms of what we should be looking to, GDP, there's been a more slow, gradual process. Occasionally, different countries have these big outsized rebasings. Maybe we're getting better at measuring activity in Africa. And I mention this because it's been a key driver of the thinking on public debt ratios. If we hadn't seen some of the really outsized rebasings of GDP in recent years, then across Africa, the debt profile, measured as a percentage of GDP, would look very different. Some economists are still a little bit iffy about this, for want of a better word. The concern is that when Nigeria rebased its GDP and discovered almost overnight that its economy was 89% greater than it had previously thought, well, the problem is that the amount of revenue collected by the Nigerian government hadn't grown anything like 89% overnight. So when we're looking at various metrics that we use to assess the creditworthiness of different African economies, debt to GDP is a key one. In Kenya, we know that that ratio has crept up to about 56% of GDP. Moody's recently put Kenya changed the Kenyan outlook on the credit rating to negative, the likelihood of a downgrade, because of the concern that that debt to GDP ratio might get to 60% in the near term. And one thing we need to factor in is that if it hadn't been for those outsized GDP rebasings that many countries saw, those debt to GDP ratios would look a lot worse. So keep in mind that cycle, look at the consistency of economic statistics, how good different statistics offices are getting at measuring things. Another key trend was just this variation in monetary policy, explained by the adjustment to the commodity price shock. For oil importing countries, the decline in oil prices was obviously good news. Across East Africa, current accounts tended to correct on the back of that news. We started to see inflation coming down in a big way. But a lot of that positive boost from lower oil prices has run its course. Oil prices are now rising, and this will have implications, we think. For the oil exporting countries, there was still an adjustment going on. And so we saw these countries, Angola, allowing its currency to depreciate significantly only just very recently. Nigeria opting for more currency flexibility last year. This meant that those central banks have needed to tighten. But across Africa for much of this year, as much as we do see the pressures associated with rising oil prices, there is still this belief that we're at a point in the cycle where easing becomes possible, that this will provide a stimulus to growth. We also know that in terms of the revival of interest in Africa's debt markets, the return of this good feeling about global growth, the return of animal spirits and high-risk appetite has meant that it's been possible to continue to issue Eurobonds. There was a brief hiccup following the commodity price correction. 2016 saw lower levels of issuance overall. In 2017, the borrowers were back. And given where global conditions are, given where risk appetite is, we think that markets are still very much open to any frontier market issuance. But this has been associated with problems, as we know, concerns about how much of a rise in the debt to GDP ratio is comfortable. And almost across the region, to a varying extent, you can see that there has been a sizable rise in public debt to GDP. Now, when you look at Kenya on that second chart, it almost looks to have had a very benign experience by regional comparisons. And that's only because you have the likes of Mozambique on that chart. Mozambique, where the discovery of hidden debt meant that they had a problem of debt unsustainability. They were not even able to keep up with the debt service commitments. Other countries with very shallow domestic debt markets that have been very much more dependent on this outsized external issuance. As much as we see growth returning to African countries, this is something that could well have implications for investors' willingness to keep on financing these Eurobonds, to keep on buying new Eurobonds, for governments to be able to keep up with the infrastructure spending that we've become very used to. With greater external debt issuance, another important consideration is also what happens to the exchange rate. And we've seen great variation to do with global factors in recent years. In 2015, everyone was looking at how much the Fed would tighten. The dollar was strong, commodity prices were weak. Across Africa, we saw a great deal more foreign exchange volatility. In 2016 and 2017, a lot of that seemed to calm. What do we expect going forward? Well, there's still this expectation that the Fed are not going to surprise us, that any removal of monetary accommodation will be done at a very gradual pace, that we're not going to see these big shocks. Across the region, despite higher oil prices, we're still seeing a comfortable trend of inflation coming down, and we do expect a lot of easing. So at the outset, we're not expecting that 2018 will be a year of unexpected shocks and exaggerated volatility in African currencies. But we do need to pay attention to the risks if we're really going to be comfortable with the idea of relative currency stability. We need to look very closely at the factors that are likely to support that or not. And here's something that worries us. We know that there has been an adjustment to weaker commodity prices in Africa. So if you compare foreign exchange reserves in the region, where they were at the end of 2014, where they were at the end of 2016, you'll see that many countries had experienced over that time pressure on their foreign exchange reserves. If you look at the black line on that first chart, this tells you what the most recent foreign exchange reserves release was. And in many instances, this is good news again. Reserves are back to the levels that we had seen at the end of 2014, when the commodity price pressures were just starting to exhibit themselves, were starting to be seen. Some exceptions, in some cases, Ghana, which has seen a big rebalancing, helped along by an IMF program, a very rapid narrowing of its current account deficit, reserves are even higher. But the problem is that it isn't in all cases that we can say there's been organic buildup of reserves. A lot of the time, what seems to be a new strength really only reflects the amount of external borrowing that was done. And those reserves may well have to be ring-fenced to meet debt maturities as they come up in the future. This is going to be a key concern. We saw a particularly stark impact on the Central African franc zone, where a lot of those countries are oil producers, but have a fixed foreign exchange regime. They have a peg to the euro, and so they couldn't necessarily depreciate their way to a more comfortable position. When oil prices collapsed, because they couldn't change the currency, they were forced to undergo a much more painful domestic adjustment instead. To try to create more faith in the process, a lot of those countries have signed up for new IMF programs, but it's clear that the pressures remain in place. So, what are the important themes going to be in Africa given the global conditions that face us? As you can see from the first chart, these are Eurobond spreads. It's almost like there's an investor class out there who believe that Africa is one country. The spreads tend to move in the same direction. That is just the overwhelming impact of global risk appetite. In January 2016, when fears around a Chinese slowdown were particularly elevated, we saw this widening of spreads across sub-Saharan Africa. Since then, global risk appetite has returned. Global growth prospects are seen to be good. Commodity prices are recovering. Risk appetite is back, and we've seen a narrowing of spreads. The question we need to ask is this going to last? Let's look at the second chart on this particular slide. And that shows the debt maturities of different countries. Now, unsurprisingly, 10 years on from QE, that period between 2022 to 2024, we are going to see a concentration of external debt maturities. That's 10 years on from when a lot of countries in Africa were all doing the same thing at the same time. It was cheap to borrow in external debt markets. Many of them issued 5-year debt, some of them a lot more, 10-year debt. And the big potential hurdle that could be approaching is, are we going to see countries in Africa able to refinance themselves comfortably when we hit this big hump with debt maturities? Now, we all know that if you are an issuer in external markets, it makes sense to keep on tapping markets. The way countries, sovereigns manage their debt is with a regular series of issuance so that they can handle any concerns about upcoming maturities and their ability to repay those maturities. But we're also seeing these upcoming maturities happening at a time when global conditions may tighten very considerably. And this means there's going to be a bigger ask, something we haven't seen in recent years, but probably more differentiation amongst investors on the basis of credit quality. The countries that are seen to be doing the right things, that put in place reforms, that reassure on their ability to meet their debt commitments, these are countries that will easily be able to go back to markets and borrow on reasonably favorable terms, notwithstanding a big shock that impacts everyone equally. For countries that ignore the need to reform, really have been running excessive fiscal deficits, nothing is nudging them in the direction of lowering those fiscal deficits. That tightening of external conditions could be a lot more painful, because how will they prove their commitment to reform, their ability to refinance their debt comfortably? What we're essentially saying is, we've been through some pretty easy conditions. Everyone has enjoyed the party. There's been a great deal of debt issuance. But now let's focus on real reforms. Let's focus on what is really going to be driving growth and credit quality, and who is going to emerge in a better space relative to the other countries. So this needs no introduction. We know that there's been a tendency to have these excessively large fiscal deficits, deficits that would have been problematic to finance at any other time. Because the money came in relatively easily, it wasn't seen to be such a big concern in the recent past. But conditions globally are changing. So a quick warning, when it comes to how vulnerable different countries are, in the past, if there was a commodity price shock, for example, a commodity-dependent country could always allow its currency to weaken, and that acted as a nice buffer. An exchange rate, at the end of the day, is a pretty meaningless thing. It's what we call a nominal variable. It's not a real thing. If that can depreciate and allow you to ride out an external shock, why not? The difficulty now is that some countries have taken on so much more foreign currency borrowing that that option isn't necessarily open to them. They can't rely on currency flexibility in the same way that they did in the past. Now, this was using June 2017 Fitch data. If we look at the most recent Kenyan debt data, we do know that the majority of public debt is now denominated in foreign currency. So this has key implications for Kenya. In looking at how Kenya will navigate around future shocks in terms of how it will build its own resilience, it's going to be important because of the composition of its debt. An increasing amount of that external debt is commercial. It's available on entirely different terms. It will be important for Kenya to be able to manage its foreign currency exposure in a key way. We know that the general trend in recent years, weaker growth, halting commitment to reform, has been one of deteriorating credit quality in Africa. We've seen this very clearly in South Africa, and a clear impact, a clear correlation of economic management under different political leaders there, where a country that was once rated investment grade by all three rating agencies has lost that in terms of its foreign currency rating, and unless it puts in place significant reforms, unless it can show a real commitment to reassuring on its debt build-up, it has a very low level of foreign currency debt from the public sector at least, it could be downgraded again. So the general trend stemming from the growth profile is one of halting the deterioration. Let's just take a step back here. Many of us are feeling good about the global economy, and I don't mean to be the really bearish economist who says, yes, you feel excited, but let me tell you about the things you need to worry about. We know that a natural consequence of this normalization of global growth, we haven't even gone back to where we were with the global crisis. A natural consequence of that is that the very accommodative, very easy monetary conditions that we've all got very used to, that's not going to remain in place forever. There is going to be a tightening of global financial conditions. The hope is that this happens smoothly and gradually over time, no big shocks. But if there are disruptions, if there are shocks, if this does happen in a volatile way, how are different countries poised to be able to withstand these shocks? And with that rather alarming introduction, let's talk more closely about Kenya's economic outlook. Now, I stand here as an economist where our growth forecast for the country was a little bit more bearish than the consensus all along. And this almost needs no further introduction. Was 2017 growth weak? Yes, we know this. There had been a lot of big infrastructure projects supporting growth up until the eve of the election, and then the slowdown in activity. A period of almost 6 months with very minimal economic activity. Investors waiting on the sidelines, waiting to see how things normalize before they recommit. That was obviously going to impact growth. We know that the Kenyan economy was impacted by the slowdown in agriculture. That's a no-brainer as well. A contraction in a big sector like agriculture will take something off the headline growth rate. So we had the impact of the big force driving growth in the past off a high base, infrastructure spending, not much going on in the second half of 2017. The impact of the drought, which dissipates over time, but severe enough in the first half of the year to have a big impact on the macroeconomic numbers. And then also credit growth, which had weakened considerably. On the basis of all of this, even though there were pockets of strength in the Kenyan economy, a reasonable estimate, if you like, of where growth was that there was weakness. But growth rates of around 5% are still extraordinarily good. And rather than focus on just the near-term profile, I will explain why the research forecast, at least, is sub 5% for the moment. And that is that the Kenyan economy still faces great headwinds. We know that when a central bank raises interest rates or lowers interest rates, there's usually a lag period with which that policy change impacts real activity in the economy. So even if, for the sake of argument, there were to be a change in the interest rate caps tomorrow, it would still take time for credit growth to come back in a really robust way. And even more importantly, it would still take time for that recovery in credit growth to impact the real economy in a way where demand comes back strongly. So the Kenyan economy has been encumbered, some would say unnecessarily so. The existence of loan rate caps has meant that credit to perhaps the most dynamic elements of the economy, maybe corporates without necessarily that long track record of borrowing, more entrepreneurial corporates, that has been constrained. Banks have had this inability to price for risk. And it's almost a law of economics. Anywhere in the world, If you control prices, it's the quantity that does the adjusting. In Nigeria, if you try to control fuel prices and do this against what's going on globally, then you run out of fuel. It's a no-brainer. In Kenya, if you try to set a limit on where the interest rate should be, you should fully expect that the quantity of lending might have to adjust to that. And that's essentially the credit rationing that came about in Kenya. The point we're making with these growth forecasts is, as much as there is a need to kickstart growth, to get things going again after the election, the speed at which that is going to be doable is important. And a lot of the outcomes, a lot of the growth outcomes, certainly in the first half of 2018, will almost be baked into the cake by what has already happened last year. So, these are our macroeconomic forecasts for Kenya. Let's look more closely at the story of what needs to happen, what turns things around. We know that GDP growth has slowed. What are we expecting? Fiscal consolidation. If fiscal policy is not going to be able to play a big role in boosting growth, it means the issues that have constrained monetary policy will need to be resolved. If Kenya is serious about tackling its fiscal deficit, if it is serious about promising medium-term consolidation, it will need for something other than fiscal policy to be playing a role in boosting growth. So our near-term forecasts are relatively benign, but the important point for you to note, and many of you participants in the economy, investors in the economy, is that the near-term numbers are almost meaningless. What matters a great deal more are the reforms that are put in place now that will determine what kind of resilience the Kenyan economy has in the future. And for the moment, there's a lot of uncertainty in terms of what will be done to rebuild that resilience. Here are a few policy recommendations just stemming from where the Kenyan economy has been. So, as much as you wanted to dismiss the recent growth profile, you could say, how has Kenya done overall? And we know that there's reason to feel good. If we look at this in clusters of different years, in recent years, there has been a key trend of Kenyan economic growth accelerating relative to the sub-Saharan African average. You see it in the numbers. For a long time, Kenya had been the relative laggard, not growing as rapidly as sub-Saharan Africa on the whole. The oil exporting countries really did well during the oil boom years. But recently, Kenyan growth did look as though it was coming into its own. And also in terms of per capita GDP growth rates, you'll see that Kenya has had a fairly consistent uptrend in per capita growth rates. That's a chart that we think deserves a lot more attention. So the focus of policy shouldn't just be what does Kenya do to try to fix this near-term slowdown in growth. The focus of policy should absolutely be what does Kenya do to bring about the resilience that will lessen the vulnerability, that will allow it to achieve good growth outcomes, not just a one-off, not just 1 year for 1 year, but year after year. And this is what we turn our attention to. First of all, the situation with bank lending and the difficulties created for the transmission mechanism of monetary policy. There was an MPC meeting at the start of this week. This needs no introduction to many of you in the room. Inflation has come off a great deal. Food prices are not causing the pressure that they once were on inflation. Even during the worst of that price shock, if you looked outside of food prices, there was minimal pressure. Kenya should have been cutting interest rates through that process, we feel. Conditions were right for monetary easing. The economy would have benefited from that boost to growth. But it didn't happen for a very real reason, and that is the uncertainty created by the interest rate cap and the framework around that. It isn't clear under these circumstances where banks are struggling to price for risk, so the safest thing to do is not to take those risks, to put everything in a risk-free instrument like government securities instead. This is the behavior that banks have been incentivized to show simply because of the rules that have been created for them. It's not that banks are not doing the right thing. The way that intermediaries behave will depend on the environment that they find themselves in. If there were to be an interest rate cut in this environment and the loan rate cap moves even lower, a very likely consequence is that you would see less lending, not more. You would see less stimulus, less support to the economy, not more. So Kenya has lost out at this very crucial time when headline inflation has been coming off, when growth has been slowing. At any other point in time, that would have created the room for some kind of monetary stimulus. But Kenya has missed out because of the interest rate cap that has been in place. What needs to happen? Well, we think when we're looking at the whole picture and the need for very rapid fiscal consolidation, it would help to ensure that there are other engines of growth in the economy. Given the lag with which any monetary policy change will impact the real economy, especially if there's going to be a meaningful tightening of fiscal policy over time, it's even more important that this issue is resolved. It has to be a priority. It is unnecessarily holding back growth in the Kenyan economy. It is not delivering the outcomes that are needed at all. This is the outcome of that loan rate cap. Credit to the private sector, down very considerably. The companies that could be hiring more people, the companies that would be at the forefront of generating new activity and helping to build wealth, that is not happening. That opportunity is foregone because they're just not able to access the credit that would otherwise be available to them. The government, in a rather curious way, has been the beneficiary of this. If banks think it's too risky to lend to private sector borrowers at a capped interest rate, well, the kind of returns you get in lending to government, putting your money in risk-free instruments at a slightly lower rate, that becomes much more compelling. So there's been a larger pool of liquidity available for the government to finance itself. But this raises another issue on how Kenya should exit from all of this. Because as soon as there are other avenues available, other things to do with those pools of liquidity, then the relative attraction of government securities, especially if the expectation is that there's still a great deal of issuance to come, there's still a great deal of supply, the government is hungry and needs to borrow, and if it looks like it's less attractive to lend to the government, that could have implications for market interest rates in Kenya. So the process, which is urgent, which needs to happen, which ideally should have happened already, that process is urgent. But the way it is managed will need to be thought through carefully. And this is why it's all important that it happens quickly. If we were to take a step back, what has essentially been happening in Kenya is that the economy has been receiving a great deal of stimulus. In recent years, the good, favorable headline growth performance was very closely associated with the spending on infrastructure. This was a big driver of headline GDP. And maybe it will do what other African countries have done, the precautionary facility with the IMF, which no doubt we'll be hearing about this afternoon, would be one way of signaling that it plans to do the right thing with fiscal policy. But is Kenya really in a position where the government can stop playing the key role that it has done in driving growth if the private sector isn't ready to take over? If the private sector has been credit constrained, then that lifting of the credit constraint becomes all important for meaningful consolidation to take place. Why? There are two ways that Kenya will try to cut its fiscal deficit, and hopefully what we'll see is a combination of both. Kenya needs to raise a lot more revenue from existing economic activity. For that to be growth supportive and not to constrain growth too much, it needs a private sector that is functioning strongly. Right now, the credit growth environment, the bank lending environment, doesn't allow for that to happen. Alternatively, Kenya needs to be cutting spending. But what economic shocks, how vulnerable is the economy to that rapid cutback in government spending if we see it, if there isn't anything to replace the public sector investment, if private sector investment is still weak? So that's a fairly long way of trying to explain the dilemma that policymakers in Kenya face. But we also know that GDP rebasings notwithstanding, that debt to GDP ratio has been building up. For one rating agency at least, it started to be a problem. A constant theme for many people in Kenya, many people who engage in conversations about the economy, is how much debt is too much debt. And here's where a little bit of explanation is needed. It's not wrong to be taking on new debt, especially if what you're doing is ultimately refinancing existing debt. Once you have issued in external markets, it makes a lot of sense to keep showing to borrowers that you have the ability to keep on borrowing to refinance your commitments. This is how many sovereigns the world over manage their debt commitments. But in order to bring that debt to GDP ratio down to what some would say are more comfortable, more sustainable levels, two things need to happen. Either you reduce the overall amount of debt, and there's a very simple way that you do that. You do have to have several years of a primary fiscal surplus. This means taking out what you spend on debt service. Are you spending less than you are collecting in revenue? For too long now, Kenya has been spending much more than it's been collecting in revenue. And unless that changes, the ultimate profile of debt to GDP doesn't alter very much. The other thing it can do is it can just focus on the denominator in that ratio. It can build GDP much more strongly. And this is where attention needs to be given to the enabling environment that is in place. Is it all systems go for private sector credit, for private sector growth in Kenya? Is everything in place for the private sector to take over as a driver of overall GDP growth? If that isn't the case, then something suggests that you're not going to get the stabilization in debt ratios that you're seeking. Kenya is in a comfortable place. It is not facing a crisis. It still has a sustainable debt level. But the way that this evolves in the future is going to be crucially dependent on the reforms that are put in place now. And this is why I tell you, we shouldn't be focusing on 2017 growth. It's last year's numbers. It doesn't matter. It's over. It's done with. We shouldn't even be focusing on 2018 growth. There may be a need for fiscal consolidation. Slow things down a bit. Focus on the medium term. Focus on the resilience that will really allow the Kenyan economy to perform in the medium to long term. We know from all of the economic work that has been done the qualities of those countries that achieve transformative growth. One is growth is sustained. There isn't this stop-go. It isn't about vulnerability to shocks and such bad setbacks that it's very difficult to recover. Just as you seem to be making progress, something knocks back the economy. That is not going to deliver transformation. What Kenya needs is the resilience to be able to generate growth, strong growth, year after year. And that will only be done if the correct foundations are put in place. The kind of fiscal overruns that we've seen in the recent past, the overdependence on government spending as a growth stimulus, the fact that private sector credit is as constrained as it is, that's an especially unnecessary constraint on growth. It delivers nothing meaningful, nothing beneficial to the economy. It represents a huge opportunity cost in terms of the things that could have been happening in the Kenyan economy had conditions been different. So a quick look at external vulnerability. the current account. We know that oil prices are going to be rising as natural demand momentum is restored to the economy. One would expect, other things being equal, for imports to pick up. We know that foreign exchange reserves have generally seen a big increase in recent years. We're not overly concerned about the sustainability and stability of the foreign exchange rate, as you saw from our forecasts. We think that the extent of depreciation that's likely in the Kenyan shilling will still fall short of the average inflation that we see in Kenya. This means, in real terms, and it's always the real that matters, don't focus on the nominal. Nominal is meaningless. Focus on the real. In real terms, the Kenyan shilling is strengthening. Now, is this a good thing or is it a bad thing for the economy? We could have a long debate on that. We know that Kenya now has over 50% of its debt denominated in foreign currency, so it would certainly be a bad thing to allow the currency to weaken a great deal at the risk of that debt ratio looking less sustainable. There is an immediate need to try to go for some kind of stability. Then there's also the nature of the Kenyan economy. There's been a lot of talk about doing something to stimulate manufacturing again, and manufacturing economies generally, the ones that have focused on exports, have focused on competitiveness, sometimes relying, perhaps overly relying on the currency to deliver that competitiveness to them. Kenya has strengths. It's a diversified economy. It has considerable services exports as well. Tourism has been an especially bright spot. The establishment of direct trade routes with the US could be a big boost to Kenyan tourism, security issues notwithstanding. So there is hope, and there is hope for export growth that isn't necessarily reliant on an overly competitive currency. Given that Kenya's currency has been losing competitiveness in the conventional sense, it's been appreciating very strongly in real terms over time, maybe this isn't a bad thing. If we were to summarize, and I have taken a lot of your time, I think I've hit the exact 1 hour, paying attention to time, how do we sum it all up? The global economy is doing much better. This is good news. It's something that will lift activity everywhere. It makes everyone feel good. Risk appetite is back. Problems seem to be delayed or pushed back to another day. But we know that there are risks to this profile. As we see gradual normalization, the hope is that everything that we've become very dependent on can adjust in a way that isn't going to be damaging. And we know that there's still a need for a big question mark around this. As much as global growth is back, not quite to the levels that we were seeing before the global financial crisis, there needs to be a questioning about how resilient that growth is. And this is as true for Kenya as anywhere else. This economy still has a number of strengths. It is still one of the more private sector friendly economies in the region. Kenyan growth has not been dependent on the benefits of resource wealth, which ultimately means very little. Kenya's growth experience has been for real. The per capita growth acceleration, that was for real. But in order to safeguard these achievements, in order to build on the resilience, there is a need for reforms. Over the next year, we're going to be watching things very closely. Not necessarily the day-to-day GDP numbers, because those are interesting, but it's not enough. What we will be watching very closely is the longer-term reforms, the foundations for the medium to long-term growth that are put in place, because that is ultimately what is going to be driving economic opportunity in Kenya. I thank you for your time. You will have a long time to absorb that as I hand back to Ali Khan.